we clear the SEBI.
Just wanted to point out that SBI Life is already taking note of this Macquarie call. They've upgraded SBI Life, saying that it's probably better placed and it's going to be one of the insurers that will be lesser impacted with the surrender value norms. It's actually the top performing stock on the Nifty right now. So let's see if we can actually build on it. But yeah, that one stock is definitely taking note of the Macquarie call today.
It's interesting how some of these life insurance companies have just not performed, right? If you map a 3-4 year, look at HDFC Life, huge underperformer despite having all the ingredients of being a success in place.
Tax changes, IRDAI changes, so too much going on.
Too much going on. Okay, let's get back to the market now. Looks like we're headed for a decent opening actually. In about 30 seconds, you'll have the Nifty open for the day. Overall, it's been a steady set for the market. Okay, in about 5 seconds now, steady set for the market, but all eyes will be on the Bank Nifty and the first trade over there. Let's see. The first tick on the Nifty is in the green by about 20 odd points, 15 points now. Sensex is up about 50 odd points, so not a bad opening at all. Flat, but with a positive bias, something that the market would like, as we could be perhaps building on to our gains. Let's take it to the advance decline ratio, because that is in favor of the advances. Almost 1,400 stocks on the advancing side. So definitely the broader market is also not looking too bad. The Bank Nifty is the one that is in focus this morning. The Nifty Bank up 260 points, advancing towards that 52,000 mark. Fresh record highs for the Bank Nifty day after day, and a lot of individual banks are in focus. HDFC Bank, I would like to get that one up because there's a bit of delivery buying that has gone up in that bank. Not just that, you know, the stock, HDFC Bank, is now up 15% if you look at it month on month, between last month and now. So at 1,660 on HDFC Bank. Apart from that, Kotak Mahindra Bank is the one that we're looking at this morning. Macquarie has upgraded Kotak Mahindra Bank to an outperform. And in fact, Macquarie likes a lot of the private sector banks rather than public. So Kotak Mahindra Bank is now up almost about 1.5%. Apart from that, I would also like to take a look at SBI because, you know, there is some Macquarie is actually underweight on SBI. So just pull up that one. It's down about 0.2%. PNB Housing Finance, by the way, in focus as 0.5% equity has changed hands. So do keep an eye out on that. On the flip side, though, you have IT stocks that are under pressure. Techem, Wipro, TCS, Infosys, all down anywhere between 0.5% to 1%. Nothing alarming. But it's banks on the upside and it is IT on the downside.
All right. Well, a few stocks that are reacting to news flow. MAS Financial, well, they'll raise money via QIP. That in turn will improve some of their return ratios. That stock, in fact, is opened up with a gain of closure around 4.5%. PNB Housing Finance, well, that one's under pressure. It's down closure around 4% odd. A few more notable movers. You have Som Distilleries. Their license got suspended in Madhya Pradesh. So that's down closure around 4.5%, 5% now as we speak. And Lurch Avenues, the one that recently listed, it rocketed the last couple of sessions, down closer around 4% as we speak. A few more notable movers on the upside. GMR Palm, that deal with regard to the smart meters, that stock's up closer around 5%. Jyoti Structures is up closer around 5%. Suzlon is up closer around 4.5%. And Bansali Engineering as well is up closer around 3.5%. So those are some of the top volume movers. And Delta Corp opens up in the green. There are hopes that there could be some kind of relief on the retrospective basis. So that's why that stock as well has opened up the gain of around 2%.
Lots of stocks reacting to news. Look at Tanfac. They've done an agreement with a Japanese specialty chemicals company. You know, the value of that agreement is about 80 odd million. That stock's soaring away. Then CE Infosystems and Uno Minda. Goldman Sachs has singled out these stocks. I mean, you know, that's positive brokerage commentary coming in for both. And they're really reacting. CE Info is up about 9%. Uno Minda is zooming about 7% higher. Sapphire is looking at a stock split. Sapphire Foods up about 5% in trade on the back of that. RateGain had a block deal. So that one's reacting quite positively as well. By the way, Tata Technologies was a negative call by Goldman Sachs when it pointed out a couple of these mid caps, and that stock is actually down about 1% as we see it. What else? Suzlon Energy 4% higher. Brigade is having a good morning, about 4.5% higher. I think Brigade was one of the stocks that Sriram was also talking about, a potential MSCI review maybe in August. Anyway, talk about some more. Sansera Engineering after yesterday's big block is still in focus, up about 3%. GMR Power is up 5%. Watch for this stock. They want to get into smart meters. And it's up about 5% on the back of that possibility. Advanced Enzymes, I mean, those are the names. But actually, once again, just like yesterday, the Midcap index has slipped into the negative. There's a lot of profit taking continuing on the PSU name, so watch out for that trend. PFC, REC, BEL, RVNL, BHEL, Hoodco, Railtel, a lot of these Ericon, a lot of these PSU stocks are losing anywhere between 2% to 5% as the profit-taking sets in the Nifty is very quiet. And again, this is like a screen that's mirroring yesterday where the bank Nifty is doing well thanks to FPI flows that have started trickling in, but nothing else in the market is quite performing. Apart from banks, we don't have support. We don't even have support from IT today. So that's a bit of a non-starter. On the downside for the Nifty, the profit-taking in auto is continuing. And there are also some names on the tech side which are on the lower side of the screen. So Infosys is down about 0.5%. Very quiet, getting extremely quiet, and it's just about banks. That is the trade as the money is still going in. All right, so that's the market for now. Let's get some perspective then with our market master. Krishna Sanghvi, Chief Investment Officer Equities at Mahindra Manulife Investment Management, is with us in the studios now. Krishna, great to have you right here with us. The market's not used to pauses, right? This market runs on steroids. It's almost making all-time highs on a daily basis. But pauses can be healthy. They can be very good. What do you make of things right now? I mean, is it tough to find stocks at your buy price? Or do you think this is a multi-year bull run? So why worry?
Yeah, it's a combination. Clearly, it's tough to buy a stock where you're comfortable at that point of entry valuations. At the same time, if you really decide to have a longer time frame, then something life becomes easier. Unfortunately, you don't know how much, in a way, from a time-wise, you're overpaying today. Because very effective, willing to buy in 3 and 5 year down the line earnings means it's really overpriced for the time being. And so all you need is maybe incremental, dose of order book, incremental dose of, positive announcements which possibly can help. But yeah, clearly many of these companies right now are in a situation where at least FY26 is nicely discounted and one has to stretch in terms of looking beyond.
Okay. Krishna, hi, good morning. And, thank you for being here with us in the studio. Appreciate it. How are you reading into this move in banks? Because suddenly, it's become everyone's favorite. Private sector banks have underperformed for 12 to 18 months.
Yes.
But do you think that's the only reason, underperformance, or is there some fundamental trigger for this move in banks?
Yes, so I think markets are always going to be a combination of both, some fundamental as well as this. I think if you look from a relative earning perspective, maybe banks still offer a nice spot where if you go back 6 months back, maybe there was expectation of a rate cut. And as we know, when the asset price starts repriced downward much faster, banks could have some impact. Now where we are today, maybe that rate cuts looks reasonably difficult, or the intensity can be far lower. That is one part, which is the earning side. I think if you look from a market ownership perspective, clearly that's the other angle, which says that they have underperformed beyond a point. They're all good franchises, best of situations on margin front, on credit cost front. So that's the other angle, which says companies are good. Maybe they've not moved much in last 6-12 months. They were definitely added income. They've added profits. The book values have grown. It's just that from a relative perspective, maybe the over ownership somewhere has hurt. Because when some other segment of market started doing well in terms of economy, not necessarily only equity markets. So people would have shielded some portion of money, and in a way, financials would have been a natural port of call considering the ownership pattern. So that's where some money gets taken out to invest somewhere else.
All right. Hi, Krishna. Good to see you in the studio. Give us a couple of numbers and your analysis of the same. Prior to this election outcome, everyone was going gung-ho on the Capex themes.
Yes.
Now, suddenly, post the outcome, people are talking more about consumption themes. But that lasted for all of 3 days. When you saw the FMCG names do very, very well. And the street said, maybe you have to rejig yourself from Capex to consumption. Would you look at buying some of these consumption stocks, or do you think that the Capex has a far longer runway, so you rather stick to those themes itself?
No, sure. I think, let's look at macro picture of economy. I think all sectors are interlinked. We have this concept of profit pool participation, where some sectors lead the earning growth, some sectors lag it, but net economy keeps on growing. If you look at last 10, 15, 20 year cycle, you will always find those spots where where a particular sector looks really good. Unfortunately, somewhere the valuation call starts coming into play, saying that it's good, but at what price and what's the incremental return expectations. I think if you link to election, primarily I think let's face it, we actually in the same continuation phase, so nothing incrementally is different. A lot of Capex announcement which would have happened earlier are possibly likely to continue. So it's going to be more of a valuation call, and that's where the thought process comes in, is that as and when some of those Capex cycles which was initiated some time back starts getting played out, See, what's the end game of Capex cycle, right? End game of Capex cycle is higher manufacturing, which creates, income for people who are employed. So it's, job creation. It's some Indian factors of production being paid out, as a part of this cycle. So to that extent, consumption is a natural beneficiary, as people earn, like, let's not forget, my expense is somebody's income, and that, when the other person starts spending, the third person starts earning. So I think that's how this cycle of Capex consumption gets played out, over time.
So let's talk about the portfolio construct. In general, given that this is a market, like you said, where valuations are pretty hot in most pockets, which are incrementally, what are your current overweights, and incrementally when you have to put fresh money to work, which are the areas where you still have some valuation comfort?
Sure. So I think traditionally, for last 12-18 months, Capex cycle was clearly an area of, overweight, and that's possibly helped, our portfolios as well. So that's been one part. At the same time, as I mentioned, valuation is something which is reasonably attractive or cheap 1.5 years back. It's no more the case. So to an extent, valuation-based adjustments to portfolios and maybe private banks, maybe consumption, and within consumption, honestly, it's a nice basket, right? It's you got FMCG on one side, you got consumer durables, you got within that lower price point, products versus a higher price point. So I think that range is there. So little bit consumption tilt on an incrementally basis clearly helps,
But, let me ask you a follow-up on that. The reason why the market was not buying FMCG, of course, it was always under-owned and the valuations were always good. Well, because do you want to buy something that's going to give you 4-5% growth, right? Whereas something like an ABB or a Siemens or a HAL, though trading at 50 times to 100 times, was still, giving you the prospects of more growth going ahead.
Agreed. So that's a tough call. That's where everyone gets into valuation and our own understanding of how long this cycle is going to last.
So what do you think there's going to be a change? Do you expect higher growth? The under-ownership argument is well taken on FMCG, but will growth come back?
So that's a growth argument which says that if those Capexes which were created or planned some time back are going to be operational in next 12 months, so the job creation starts, right? Because what does consumption need? Income growth for people. Now, people at relatively higher end of income possibly are not going to be impacted by incremental income generation, but at the same time, people in the mass segment, average income can shoot up because of economic activity picking up. But that's the end game, right? It's a cycle. Companies produce things and create jobs for people. So that's the
So just to complete the loop on this, have you started booking profits on the Capex side of your portfolio?
Yeah, I guess valuation led, some reduction. That's where, as a portfolio is constant, right? Finally, it's 100%. So if you want to buy something else, you need to review something else also.
Okay. Well, just a last question from my end. We have the big budget coming up. And, this is going to be a different one because this is after the third time that the government is getting re-elected, right? So I'm sure they have some aces up their sleeve. What do you think the government will announce, which could perhaps improve the mood of the market? From a market perspective, what are you looking at?
Honestly, market mood is good, right? so as she was mentioning steroids, so, I don't think, market mood needs something booster. I think bigger part is perhaps, nice roadmap of next 5-year thought process. Because it's the first budget in a way, though it's a continuation of the government on every front, including the ministry. But to that extent, what is a new agenda for next 5 years possibly can be one. Otherwise, broadly, it's continuity. I think the fiscal consolidation, which we've been going through, is reasonably good. Luckily, tax collections are nicely supporting. So I think those macro factors will not be really something different on even from a budget perspective, apart from saying that some 5-year plan, which is...
But do you think the focus area will continue to be from a market and a budget standpoint, things like manufacturing, perhaps defense, affordable housing? These are spaces that the government has been big on lately.
Yes. So I think that remains. I don't think that incrementally changes because that's what, maybe the roadmap for next, 5-7 years of this decade are all about.
Okay, all right, Krishna. Thanks a lot for stopping by and giving us your view on markets and various sectors as well that we discussed. Wishing you a good day ahead.
Thank you.
Thank you.
Well, let's get straight to a CNBC-TV18 exclusive then. Mr. Anil Agarwal, the founder and non-executive chairman at Vedanta, believes that the metal industry is in for a super cycle. I caught up with him to discuss their business outlook. Let's listen into excerpts of that conversation as he talks on his EBITDA target, demerger plans, and says he expects a valuation of around $1.2 billion per million ton for his steel assets. Let's listen in.
$10 billion is if you look at, we are the largest producer of zinc, silver, We are the only people in India doing the largest recycling of our slag, recycling, which is the most environmental friendly. So we are very confident. Aluminium, we are the largest producer, 3 million ton integrated, everything. If you look at our iron ore, look at our iron ore, we are going to produce 70 million ton of iron ore. If you look at our oil and gas, I'm so excited about oil and gas. We have offshore, we have onshore. We are the people who are producing and started exploring and the drilling program in the Northeast, especially in Big Boy and all the Assam area. So very excited about oil and gas. Each of our assets are a trophy asset.
Now, you've talked about all these businesses, put it together, but also what the street is looking forward to is the demerger of these businesses. Could you tell us the timelines and have approvals come through?
Yeah, it's all done. It's all, we have got majority of lender approval. We are in the process. NCLT take time and go through a whole process, which process will take place, and then it will be merged.
So by the end of this fiscal year, we could have the units separated, 6 listed entities of the Vedanta Group?
I think so, because certain things are in my hand, certain things are not in my hand.
Okay.
It is in the hand of NCLT. NCLT normally takes 3-4 months time, but sometimes they can take 1 or 2 months more also.
The other focal point, Mr. Agarwal, is the steel business. I'm aware that you're in conversation with various buyers, and maybe in the next couple of quarters that should get closed out. How sure are you? In the first half of this fiscal year, should we see that steel asset getting sold at a good valuation? You want to give us a hint of the valuation you're looking for?
See, first of all, on the demerger, it was absolutely important because each of our business is a independent business. And my vision is to time to come, each of the 6 businesses will be as big as Vedanta itself, because the huge demand and the demand is double-digit growth. So I'm very excited about to create value for my shareholder. Each of my shareholder will get, if he has a 1 share of Vedanta, will get 6 share of demerged company. So that was on demerger, and that was the right thing to do, making a very strong with the management. As far as the steel is concerned, steel, we are one of the best prime location of a steel asset, which is in Jharkhand, near Bokaro, is in the Bokaro. We have a proximity of all the raw material, iron ore and the coal. We are proximity of all the railways. We are proximity of all the gas. So this is the best location for anybody to start production of steel. Very clearly, our Prime Minister has said that there will be 300 million ton of steel production. And India is at the moment producing only 120,000 ton. So the huge demand supply gap in steel. So this is the one thing which is a brownfield, which can produce 20 million ton of steel. So we have put this asset on the basis that if we get 1.2 billion per million ton, we have a 3.5 million ton of plant, which at the moment we are producing close to 2 million. 3.5 will be by end of this year. So we are 100% sure that if we get $1.4 billion and get not the distress sale, if somebody has a vision to produce, take it forward, we will look at, and if we get a price of $1.2 billion per million ton, we may consider to take the view.
All right. So your ask is that per million ton, you want around $1.2 billion. Are we getting that correct?
3.5 million ton. 3.5 million ton.
So what is the total valuation you're seeking for this 3.5 million ton plant?
Yeah, around 4.5.
4.5. Okay, all right. That appears to be a tall ask. And how confident are you that you see, this getting closed out in the first half of the fiscal or sometime during the fiscal itself?
We are very comfortable every of our shareholders want us to be in the steel business. We are already producing almost 2 million ton steel in Goa. So both put it together, it will be 5.5 million ton. We have strategically decided not to be in a steel business or become very big in the steel business. So we are getting very good response internationally and nationally. This is a very good, if you look at, this is the norms of the price, 1.2 billion, because the assets are not available. If anything comes, we look at, otherwise we'll keep expanding our plant.
Let's talk about the zinc assets as well. You know, that stock price itself of Hindustan Zinc has more than doubled in this calendar year itself. Any conversation with the government of India? We were talking about an OFS as well a few months ago. When do you expect that to happen?
See, zinc we are the only producer in the world as a major producer. If you produce 300 million ton of steel, which is India going to produce 300 million ton of steel, then you need 3 million ton of zinc production. We are only producing 1.2 million ton. So it is a question, and no, you cannot start zinc mines again. So this is the one which is the business which we are going to expand at least 2 million ton time to come, because that is the requirement. I'm always averse about import. So very excited about Hindustan Zinc. Hindustan Zinc can be any price. It can be $100 billion company. It is a company, and whenever government want to sell, they can sell. It is up to them.
All right, but you haven't heard about a potential OFS in the near term?
We hear every time, it is always in the government's mind to sell the shares. They call us, they decide us, they give the mandate to the bank, but action has to be taken, and I'm sure something will happen.
What about at the parent level? That's the fear from a India stockholder's point of view. How is Vedanta Resources placed? You know, on the debt, in the last few years, you've gradually been repaying some debt. And now you're far more comfortable if you even talk about it, you know, in comparison to what it was 2 years ago. It was close to around $10 billion, which has come down drastically. What's your message to the shareholders here of Vedanta Limited? And what's the deleveraging plan at Vedanta Resources?
See, the total debt on the Vedanta Resources, Vedanta Limited is the subsidiary of Vedanta Resources. All put it together, the total debt in the company is $12.5 billion, which is not even 1.5 time or 1.2 time of the profit what we make. As far as the total debt on the top is concerned, we have the trophy asset on the top, which is, we own the largest copper deposit of the world called Kankula Copper Mine, which is on the top. And we are looking, people are looking forward from us. Would you like to dilute some equity into the KCM? We haven't thought anything so far. I think we are very comfortable to address the debt. We have a good cash flow and good dividend that should take care of all the debt payment of VRL.
Could you look at folding in KCM into the listed entity Vedanta Limited? Would that be an option?
I don't know. At the moment, it is with the private company on the top. I'm ready to do anything possible which can help my shareholder. Okay. And I promise that the first preference of Kankula Copper Mine, copper will go to India.
Okay, all right. You know, the Vedanta Limited stock, that's bounced back, and it's bounced back in a huge manner. What's the plans with regard to your holding in the company? It's come down a little bit to around 61.5% or thereabouts. Will you look to reduce stake further? And also, are there any plans of diluting equity?
We have 62%, 61 point something percent of holding on the of the company, and we are comfortable. Any investment bankers comes and give me some idea, we will work on. At this point of time, there is nothing on the card to take our holding down below 61.5%.
Okay, that's a very exclusive conversation with Anil Agarwal of Vedanta. But let's just take one look at the market because it's getting a bit volatile now. The Nifty, in fact, is down. It's down almost about 70 odd points, and all this in the last 10-15 odd minutes. If we can just get the Nifty up for you in a bit. The Midcap index is also coming in for some profit taking. We'll just wait by for that to come up on the screen as well. Remember, things have been tricky for the last couple of days, but today doesn't look like it is a good start to trade at all. Still waiting. There you go. Okay, 30 points lower now on the Nifty actually, and the mid-cap index, okay, holding in the green. Let's slip into a quick break. Up next, Adish Patil of Arty Drugs will join in to talk about their business outlook. Later, we'll connect with Dinesh Kumar Khara of SBI to discuss their business outlook as well. Stay tuned.
Welcome back. Well, let's focus on Arty Drugs then. That's the stock on our radar as the company's Tarapur unit in Maharashtra had a fire incident which caused temporary disruption of production. Mr. Adish Patel, the CFO of Arty Drugs, joins us on the show. Hi, Adish. Good morning and good to see you in. Well, with regard to this disruption that we have seen at this unit, could you quantify it on the financials? What was the potential revenue loss because of this fire?
Yeah, so this happened actually just outside the plant of one of our anti-inflammatory drug. So that drug contributes to around less than 3.5% to the overall sales. So that way it is not big. And as far as the fixed asset loss is concerned, we are estimating, it is a rough estimate that it will be below 1 year. And we do have IAR policy, which will cover this loss. So from the loss point of view, it is not much. But it might cause a production disruption for around 10 to 12 days, probably. This is just a rough estimate.
Okay, so 10 to 12 days of production disruption, but you don't see any kind of loss. Any timeline that you can give us on how long the operations could be suspended?
Yeah, so probably in 12 days or so, we will try to resume the operations. But that is just for the one product. Rest of the products are working fine.
Okay. So in 12 days, you'll resume operations. Got that. So good to hear that, the losses are also temporary for you and fairly small in amount. Let's get to the business then. You had said earlier that your margins can improve by an additional 100 basis points. I think you've seen about, in Q4, your margins improved to the best levels in many quarters. So what is the kind of guidance that you have? What are the margin levers for the company?
Yeah, so the main margin lever for the EBITDA would be gross margins itself. So we are estimating that this first quarter of this financial year will be even better as respect to the previous quarter, maybe by 0.5% or so. That is totally because of the base effect and the normalization of the prices versus the input cost. On the side, we are also doing a lot of process R&D to improve the efficiency of the process, which will also lead to better gross contribution. The only hold-up for the first quarter might be that we just had started our salicylic acid plant. So because of some equipment problem, we were not able to fully scale up. But then we will be expensing out all the depreciation and the interest costs, which might hit P&L a little bit in the first quarter.
Okay. If you could help us with an update on the overall revenue targets that you have for the year, Adish. I think earlier the longer-term revenue target was about 4,000 to 4,500 crores of sales. That was over a longer roadmap, I mean 3 to 5 years.
Right.
And then, I mean, you have a Capex plan also coming on stream. Could you give us a slightly more near-term target? How is FY25 looking from a revenue standpoint?
So for this longer term target, there were two main greenfield projects which were ongoing. One of which was salicylic acid, which we have just started in last quarter. Just teething problems are there, but we'll be sorting out soon, and probably within 5-6 months we'll be able to streamline the production. And as far the other backward integration project was concerned in Saika, that will be coming online in next quarter. So both these projects will help us boost our top line as well as the margins because of backward integration. And the near-term target for this current financial year, we were estimating around it's a good double-digit volume growth, but we are also expecting negative rate variance in the first half of the year. That was because last 4 quarters, sequentially the price, input cost as well as the selling prices were going down. So we are estimating that probably with respect to the June 2024, that is the last financial year quarter, there might be still 10 to 11% price degrowth.
Oh, okay. So 10 to 11% price degrowth in the June quarter. So what is the expectation? Do you think it will start normalizing by the second half? I mean, that's what we're hearing from at least some companies. And again, then where do you stand? You did revenue of around 2,500 crores in the previous fiscal. So again, going back, long-term roadmap, we get 4,000 crores. But this year, is it realistic to expect that at least you'll start growing again? Because last year was a dip in the top line.
Yeah, so last year it was totally because of the rate variance. We actually had a good volume growth, but because of the rate variance, it went down. But in spite of that, in spite of the selling prices going down, our gross contribution kept on improving. So that is a very good sign.
No, but when do you expect a recovery in pricing? Like you're saying, the price erosion is quite significant in the June quarter. What are you expecting in Q2, Q3?
Yeah, so right now, if we see last financial year, the prices kept on falling every quarter. June it was higher, September it was lower than June, then December it was even lower, and March was lower, and it stabilized at that point. So if we compare with respect to previous quarter, that is the March quarter, probably there won't be much negative rate variance in June quarter.
Okay, earlier your long-term revenue target was to achieve 4,000 to 4,500 crores of sales in about 3 to 5 years. Just to get back to that discussion, is that still on track? And what do you think the long-term levers could be for the company?
Yeah, so that is quite on track. So there are 2 greenfield projects which I just spoke about, and other is the formulation business, which is also growing. We just had USFDA inspection for our oncology plant of formulation. And plus, we are also expecting a UK MHRA inspection very soon for the OSD facility adjoining it. So our formulation business is right on track, and we are targeting export market for formulations. And already we have crossed around 50 to 55% of the top line is now coming from the export market for formulation. So that is right on track. And the other part was about the greenfield expansions, which we are doing at the API, spec chem, and even intermediate side.
Okay, we'll leave it at that, Adish. Thanks a lot for joining in. Appreciate it here on CNBC TV18. Well, that is Arty Drugs. But for the market, still slightly down, but not out, actually, you'd have to say. I think now the fall from the day's high is getting a bit worse. So just pull up the Nifty. I think there is about
23
look
points.
at that. Yeah, it's down about 23 points. But from the highs of the day, which was at where we started off, I think it's about an 80-90 point fall. So it's getting a bit volatile. I mean, look at the jagged edges on the screen. But still, largely, you'd have to say consolidation with a bit of a negative bias.
But, today, Sonia, it's a different day from yesterday because we don't have the big, bazooka, we don't have the US market, of course, but the big bazooka bank trade that started yesterday. Yeah. It's really fizzled out. The bank Nifty isn't doing much. I mean, it's barely trying to hold on by the skin of its teeth. The good news for the market is that midcaps are seeing buying again. The midcap index had started a little subdued in the morning, but again, now it's moving higher. By the way, we have a very special guest who will join us, in I think the next couple of minutes on the show. I think we do have him right here with us, Mr. Dinesh Kumar Khara, Chairman of State Bank of India. Mr. Khara, it's great to have you. Pleasure to have you with us on the show today. Lots to talk about, including the environment, policy roadmap, and how you're seeing, of course, lending trends shape out. But tell us, I mean, we're rounding up the first quarter of this year. How is the sentiment on ground? And I think when we started the year, the whole premise was whether this will be the year when corporate credit will really start taking off. Do you see signs of that happening?
Good morning. First of all, thank you very much for having me on your channel. Well, of course, what we expected, we actually get to see on the ground, and also the kind of initiatives which are now being taken in terms of push to the infrastructure. So I think this will eventually culminate into growth all around, and this will be seen in terms of growth in SME, growth in private borrowing also. So I think it's a very positive sign which we get to see on the ground, and hopefully monsoons will also turn out to be good this year. So which also means that the rural economy will also be looking up. That's how we are reading the things currently.
So it always helps. I apologize for this, but we have to look at some numbers. So if you could put some numbers to it, what is the target for you that you've set forth in terms of credit offtake this year? And how much will be driven by rural? I mean, what will be the target on the rural side? And how much, again, I'm going back to the question, corporate credit growth, what can be the numbers or some range that you think we'll get this year for SBI?
Yeah, sure. We are hoping to see the credit growth in the range of about 14 to 16%. And we expect to see very broad-based growth in credit, right from SME, agriculture, retail, and also in the corporate. So this is something which we have already planned for the current year, and we get to have a similar sense when we see the activity on the ground that there is enough ample demand. That is something which is quite encouraging.
Sir, just a question on credit growth, and we'll have Lata joining in the next couple of seconds as well. I remember the previous RBI policy, and I remember categorically what the governor stated. He said, no, this is unsecured lending, and he said, we're watching all the incoming data very, very carefully, and then we'll evaluate whether any further steps need to be taken. What's your sense on unsecured? There's been a marked slowdown. The FY24 numbers, if I remember the numbers correctly, from 23% growth on the unsecured side, it came down to 17%. What are the trends now? And, would you anticipate any more central bank action on this?
I think as far as unsecured credit is concerned, at the material point of time, we were seeing that there were many entrants into the unsecured lending space. And also they were getting into lending without really evaluating the repayment capabilities. And that is the reason why RBI came down in terms of increasing the risk weights. But what we observe is that as far as we are concerned in State Bank of India, our unsecured loan book is pretty good, because we are actually offering unsecured loans to those who are maintaining their salary accounts with us. So that is one of the reasons why perhaps in terms of our quality as far as unsecured loan book is concerned, it is the best. So we are seeing the growth which is reasonable in terms of what we have seen in the previous year as far as unsecured credit is concerned. So I think we don't see any challenge as far as our unsecured credit book is concerned.
Mr. Khara, more than credit, I guess it's deposits that all of you bankers are chasing after. What is the state? Do you still have to does the system have to still up deposit rates?
Well, as far as deposits are concerned, it is normally seen during the inflationary conditions that depositors normally chase for the better yield instruments.
So there is no inflation now. There's no inflation now, sir. It's below 5.
No. But at the same time, we have always seen that, in such situations, people will be looking at a real return, and which would be plus of the inflation, whatever it is. So that being the scenario, that is something which you have seen, that moving of money from the deposit to the markets. I always believe that there is a process of stabilization in all these markets. So we hope to see some kind of a stabilization in this trend also. What we have already seen, if at all, it is some kind of an indication. If we compare on growth in deposit on a first quarter basis, we have seen a slight improvement in the deposit growth for the banking system in the current quarter as compared to what we had seen in the previous quarter. Having said that, I must also mention that deposit is also a function of liquidity in the system, and liquidity in the system has been just adequate. So that is the other reason why perhaps not excess liquidity being in the system is also one of the reasons for the kind of trend which we have seen. But yes, of course, when it comes to CASA, it is almost at a pre-COVID level. So I think, of course, it has come down as compared to what we have seen during the COVID. So it should not be as much of an alarming situation for the system. But nevertheless, yes, this is a reality in which.
So is quarter on quarter your current and savings have improved as a percentage of the total deposits?
Absolutely.
So
Absolutely.
what does all this mean for margins? If not current and savings, but time deposits are still being chased by bankers, should we expect some margin, crunch for the banking system and for yourself?
I think for the banking system, I have not got a clear visibility of the data. I would not be in a position to comment. But as far as we are concerned, we have slightly tweaked our deposit rates in some structure, in some periods for the term deposit. And likewise, we have also tweaked our MCLR because there was elbow room which was available.
Yes.
And that was something which helps us in ensuring that there should not be any impact on the NIM. And we, as far as we are concerned, our domestic NIM last year was 3.43. So I expect our domestic NIM should be around the same number.
Oh, that's good to hear, because there was a worry about a few basis points lower NIMs for banks. Now to come to what Surabhi was asking you about loan quality. We hear about MFI loans under pressure. We hear about unsecured loans under pressure, credit card loans under pressure. What's the situation in SBI?
As far as we are concerned, we don't have a challenge as far as our unsecured book is concerned. I've said it in the past also. And even now also, I maintain my stance. Because when it comes to our unsecured book, we are extending that to those who are maintaining their salary accounts. We have got a very clear visibility of the money flowing into their accounts. And we are very mindful in terms of their repayment capability, etc. So we don't have any challenge, and our unsecured book stays as good as it used to be in the past. And
but
as far as
MFIs
are concerned, well, of course, I think the rural went through some challenges at some point of time, but now we are seeing positive trends. But yes, of course, we do hear from MFIs who are having a loan book that there were some challenges. But I think as far as we are concerned, we don't see any kind of a stress. In fact, in our case, we are seeing even better trajectory as far as the loan growth to the MFIs are also concerned, and also the quality of the loan book also for the MFIs.
Okay, that's good to hear. Now, the big trend, and yesterday we went, gangbusters reporting it, is the way in which promoters are taking advantage of this stock market largesse. So much of either fundraising or people, selling off their holdings. When are you coming to the market? You have a lot of subsidiaries.
No, as and when there would be a felt need, we will certainly reach out to the market. But we look at all possible options, and we evaluate them well in terms of the cost. So that is something which is a deciding factor and the guiding factor for us. So
need is when you need, the market won't be kind. And in any case, your CET1 is lower than other banks, maybe with good reason. You have a huge government holding as well. But nevertheless, you can want your CET1 to be equal to the other banks if you wish. The market is kind. So should we expect anything?
I would like to give a perspective when people talk about the CET1. The CET1 should be seen in the context of the RWAs. And, if at all my CET1 is being compared, when my RWAs are 52%, is being compared with somebody who has got a RW of 85%, it's not a fair assessment. So I think that has to be kept in mind. So from that perspective, in fact, what we have seen is that in last about 3 years' time, we had brought back about 1.10 trillion worth of profit into the balance sheet. So that itself has given us the muscle. And even at the current level also, we have got
No,
adequate
Mr. Khara,
capital.
I'm not alleging that your balance sheet is weak. I'm only saying that you can always want to. You can always want to increase the CET1 because the market is in a good spot. So anyway, I mean, without all these arguments, are you looking to tap the market, and which subsidiary would you look at?
As far as subsidiaries are concerned, we have not yet given a thought. And as far as bank is concerned, we certainly intend to raise some money from the market, which would be either in terms of bonds.
Okay.
So that is something which you have already come on. It is already in the media also. And we keep on evaluating our balance sheet position. And even at the current level, we can safely support another 7 trillion worth of asset growth. But yes, of course, we keep on evaluating our capital position. And at the right and opportune time, if need be, we will reach out.
So not ruling out an equity capital raise this year, sir? You're not ruling it out. It could happen.
So I always keep the options open.
Okay. So one
Fair
more
enough.
expected credit loss. 1 minute.
Exactly.
So let me
get on that. Lata, that's exactly what I was asking.
Yeah, expected credit loss, sir. Are you expecting RBI to pursue it? What is the status now?
Regarding? Sorry, I could not get
Expected
you.
credit loss rules. The expected credit loss rules.
I think if at all it comes for banks like us, we have got excess position which is there with us. It will be rather good. But yes, of course, it is a decision which has to be taken by the RBI.
Okay, so that is on ECL. I mean, in the past, you've had a view on it that perhaps it's not something to be sort of too concerned about. But just any further sense on if the norms come in the format in which they were discussed, then what could that mean for SBI? That's on one hand. And the other burner that we've got burning is on project financing, right? You said right now there's no risk on the horizon, but the RBI is clearly trying to shore up the buffers, as the credit cycle picks up on the corporate side. So on the project financing norms and the higher provisioning requirements that are being spoken of, what's your view there?
See, as far as ECL is concerned, first and foremost, I would say that over the period of time, the loan book of the banking system has improved significantly. So if the ECL comes, perhaps whatever competition was done, maybe about a year back, banking system would be much better. And we are certainly much better as compared to where we were last year. So I think from that point of view, we don't expect any kind of an impact on us as far as the ECL is concerned. Your second question relating to the provisioning for the project
financing.
Yeah, it was essentially, as of now, it's a discussion paper. I think the deliberations are going on. Various stakeholders are reaching out to RBI with their views. I'm quite confident that RBI will be giving due cognizance to the viewpoint of various stakeholders and will come out with some kind of a measure which will be balanced in terms of its nature. So that's what my sense is. But yes, of course, we are evaluating. For us, we are not envisaging any challenge. But yes, of course, we are very mindful of the views of various stakeholders, and we have to keep that in mind.
So provisions may go up, you think, if it is almost the way the discussion paper is?
No, again, if at all it comes through the ECL structure, then perhaps it will undergo significant change.
Okay, so I think we have to just wait by and see what the final guidelines are on this, and then of course we'd really be, happy to get your perspective on it. Thank you very much, sir. Great conversation with you. Really appreciate you taking out the time this morning. Right, that is the word. Thank you so much. That is the word from State Bank of India. Right now, we have to quickly get back to the market. We have Mitesh joining in, and the market's been fairly volatile, with the mid-caps outperforming, but the other large indices are absolutely quiet and flat. Mitesh, what are your trades now?
So as I said in the morning, I think today is one day when we have got some sell calls, and I think there's some choppiness. I think there's some that signs of early profit booking is playing out. But right now I have a buy on AB Capital, which has managed to get past the pivot of 240. So keep a stop at about 239, maybe even 238.5, and look for a target of roughly around 260 on the upside to begin with. We can eventually look at higher levels. And the other stock which will have is sell on Bajaj Finserv. We've been bullish on financials and the private sector banks, but Bajaj Finserv is showing some signs of profit booking. So we'll keep a tight stop at about 1600 and look for a target of around 1540.
Okay, all right, got it. Mitesh, thanks very much for those trades. We'll have to take a quick break on that note. We'll come back on the other side and we'll put the spotlight on the commodity space with Manisha Gupta. Stay tuned. Welcome back. As promised, let's put the spotlight now on the commodities space. We've got Manisha joining in with the commodity that she's tracking today. Which one is on your radar today, Manisha?
Sylvie, thank you for that. Well, I'm looking at the agriculture commodities, and the big news clearly in last 24 hours has been the MSP hike for those 14 commodities for the year 2024-25. Well, usually this number comes in the first week of June, but then we were busy with elections and counting, and is the reason we're looking at these numbers now by the third week of this month here. Well, the higher prices are expected to encourage more sowing. The farmers will get nearly 2 lakh crores as MSP for this new season, which is higher by almost 35,000 crores as compared to the previous season there. But there is rising cost of production. We've seen electricity prices gain up, the fertilizer prices on the higher side as well, technology, view, etc. has all gone up, and so has the cost of the environment-friendly seeds as well. So all of that is added into the price, and then 1.5 times is how the MSP has been decided. It is the CSCP recommendations that you get from all states, and an average of that is what Centre decides as in sense of the commodity. Well, remember, the government has put various restrictions on exports of rice and wheat and sugar, and we saw various steps being taken by the government in last 6 or 8 months in sense of controlling inflation there. We also have imports of various pulses and edible oils coming in at a zero duty also. So if we are looking at a good monsoon, a higher MSP and a good production, then we could be looking at all of those curbs changing as well, all of those restrictions being eased as well. So take a look at the numbers then, and we have seen MSP being hiked between 1.4% to 12.7% on the higher side. I'll start with paddy, and that's the most favorite of crops. 5.4% is a moderate change coming in for that. And this is about millets or coarse cereals, where we are looking at 6 to 11% of a hike in sense of MSP. Well, this is an area that the government has been promoting for some time. Maize, 6.5% of a hike in MSP, and this is important as well because maize is food and feed and fuel as well, and we are importing some maize at this point in time. Pulses, the inflation has been much on the higher side. Tur and urad have been a bit of a concern, so we've seen 6 to 8% of a hike come in for this one. Moong, the MSP hike has been quite strong in last 4 or 5 years, so we're looking at a much lower at 1.4% there. The edible oils as well have seen good gains, 6 to 6.5% of a jump up in sense of MSP hike has come in for this one as well. Now, importantly, when you look at the last a couple of decades or so, we really have seen the food prices jump up. Well, the hikes that we have seen for 2024-25, well, this is about cotton as well, 7% of a jump up coming in here as well. So this is on the higher side of it all. And Niger seed clearly is the highest one with 12.7% of a gain in sense of MSP here. So good amount there. The least has been Moong and the highest coming in for the Niger seed there. Now, this is what we've done in sense of paddy. In 2003 and 4, the paddy MSP was 550. We saw it double in next 10 years and then double again in next 10 years. And then we're looking at a 5% increase in last 1 year itself coming in for this one. So this is where your food inflation perhaps comes in from. The next one I want to show is about tur. 2003 and 4, the MSP was 1,300. We've seen it double in last in a decade and then double yet again. And if you look at the last year and this year, it's a considerable jump that we've seen come in for tur also. Moong is on your screens, and as I was telling you, this is a commodity that has seen very strong MSP increase in last 20 years. So this year, the last 1 year that is, it has been slightly on the lower side. Cotton should come in on your screen as well, and we have seen strong MSPs come in for this one as well. And from 1725, and this is something that the textile companies perhaps would also want to see. Interestingly, there are various reports now suggesting that in last 10 years, the MSP has increased by a CAGR of 10%, while the production has increased by a CAGR of just 2%. So even as we have been looking at hiking MSPs in last many years, the production clearly has not reciprocated in the same sense.
Okay, thanks a lot for that, Manisha. That's the update as far as the commodity space is concerned. The Nifty is largely flat, not doing too much at this point in time. So let's take stock of individual stocks. Ekta is joining in to tell us why you should be watching Sun Pharma this morning. Ekta, over to you.
Thanks for that. Well, Sun Pharma is in focus because their Dadra facility has received a warning letter from the US FDA. Now, remember that they already had received an official action indicated. It was inspected in December of 2023, received an official action indicated status, which indicates that there are regulatory issues on that particular facility in April of 2023, which is now escalated to a warning letter. The good part is that it's not received an import alert. If in case it was an import alert, it's most likely, generally what happens is that the import alert is issued directly before a warning letter. However, that is a risk that one will have to see if in case that does come about, because with a warning letter, what tends to happen is that production can still go on in the facility, while for an import alert, the production has to stop. Warning letter, there are no further new approvals which will come through. Now, in terms of the impact, this particular facility manufactures the API for Revlimid generic. So hence, that's probably going to be one of the key issues to watch out for. But otherwise, the street seems quite sanguine on a larger scale, because most companies, larger companies, have managed their regulatory issues quite well in the past, and that's the expectation. And once there was an OAI issued, the street was anticipating that it could probably escalate to a warning letter as well. Larger scale,
thanks.
Yeah, back to you.
No, please go ahead. Please go ahead.
Larger scale, Sun Pharma is facing an issue with the Halol facility as well as the Mohali facility. So this joins the list with them.
Okay, Ekta, thanks a lot for that. Well, that's on Sun Pharma and why it's down about 1.5%. But Sonal is with us to talk about office space solutions. Sonal, over to you.
Thank you so much for that. Well, the company just listed on the bourses, and this is the first earnings that we have from the company. This is, of course, Q4 earnings, but the numbers look good because this is the first time on a quarterly basis the company has seen profits. Revenues, they went up by 44%. EBITDA was up 35% to come at 65 crore rupees. Profits at 1.3 crore rupees, which compares with a loss of 13.7 crore rupees on a YOY basis. If we look at the segmental breakup as well, the co-working spaces and the allied services, where the revenues grew by 27%. Their construction and fit-out projects, the revenues went up by 150% to come in at 58 crore rupees. And if we map the trajectory in terms of losses as well in last couple of financial years, this is the year where losses have declined substantially versus the previous year losses of around anywhere between 42 to 57 crore rupees as well. The company said the exit monthly occupancy for FY25 stood at 71%, and the outlook is also very positive according to them.
Okay, thanks a lot for that, Sona. Let's slip into a quick break. On the other side, we start our pre-budget analysis. Lata will connect with Dinesh Kanabar, the CEO of Dhruva Advisors, and Sudhir Kapadia, the partner tax and regulatory services at EY, to check out what tax changes we can expect in this budget. Stay tuned.
Welcome to our pre-budget specials. For all of us, budget is all about taxes. Can we expect some cuts in income tax, in other taxes, and what other tax-related changes? Joining me now are Dinesh Kanabar, the CEO of Dhruva Advisors, and one of the leaders presenting the tax proposals for FICCI. Also joining me is Sudhir Kapadia, the partner tax and regulatory services at EY. Gentlemen, good morning, and thank you very much indeed for your time. Mr. Kanabar, I'm going to start with something which Money Control reported, that the government is planning to raise the minimum threshold for taxes from the current 3 lakh rupees. We don't know 4 lakh or 5 lakh, but you have done some elaborate calculation. How much is the loss? Will the government be able to afford it?
Yeah. So thank you, Lata, for having me on the show. And as you look at the individual tax proposals, probably this has been an ask which comes up every year. There was a huge expectation even last year that the government would sort of raise the threshold level. There are 2 regimes, as you know, Lata. Today we have the old regime and the new regime. Fortunately, the government wants everybody to converge onto the new regime so that you don't have a lot of deductions and exemptions that you are asking for. But in either regime, every 1 lakh rupee reduction or other increase in the threshold limit would lead to a reduction of tax revenue by about 14,000 crores of rupees. And remember that while there's about between 13.5 and 14,000 crores is an approximate number, that leaves a lot of money in the hands of the individuals. That money goes back into the circle for spending. That results again in a higher GST collection. So it is not 14,000 net going away, but really just from a direct tax perspective, that 14,000 crore is a number, which looks like a more approximate number for every 1 lakh rupee increase in the threshold limit.
Fair point. And I think the last time this bottom was revised up, if I'm not mistaken, was, I think, 2017. I could be wrong, but Mr. Kapadia, your sense, you know, inflation has eaten a lot from 2017 onwards. We have had some years of even over 6% inflation. Is that a fair expectation now? And as Mr. Kanabar's team has calculated, 14,000 crores gross is what the government will lose. So would you place a high bar on this expectation?
Well, the question is why now? Shouldn't it have been done before the elections if that was the, you know, the whole purpose of giving these? So anyway, but leaving that aside, I don't know if 14,000 crores would be really a big benefit or not, but I think the larger question is that are we now ready to come out with a clear mandate to say, let us not have a choice, but simply have only one simplified personal income tax regime without any major deductions and exemptions, and in lieu of that, have the lower rates across at least the lower slabs, let's say up to not 15, but even going up to 30 lakhs, to give relief for those income earners for whom those deductions will no longer be available. Like when we had GST, we talked about a revenue neutral rate such that government doesn't loses, and at the same time it is, you know, for commodities, etc., which common man uses, it is not burdensome. Similarly, we can do an exercise of a broadly revenue neutral slab rates, as I said, let's say up to 30 lakhs, and just have one simple, real saral, one-page tax return form for compliance. That would be real reform.
Okay, yeah, actually, Mr. Kanabar and the FICCI team has put out a lot of ease of doing business requests. And I take your point that why should the government reduce now when they didn't cut before? But this is not necessarily only a populist thing. We got the GDP numbers on May 31st, well after the elections were underway. And one of the things that clearly stand out is personal consumption is growing much slower than capital formation. So there may be some ask over there. The election results are also being interpreted as pain at the bottom of the pyramid. Okay, Mr. Kanabar, the other big expectation from the market, we do not know whether the government is in a mood, rationalizing capital gains. What can we expect? What would be the best way out?
You know, Lata, as they say sometimes, that be careful what you wish for. The point really is that we today do have multiple rates, we do have multiple holding periods, we have a distinction between the rate of tax payable by residents and non-residents. And even as we are putting together this whole chart and sharing it with you, Lata, you could see the complexity involved, and therefore rationalization is indeed needed. But rationalization towards what is going to be an issue? The fact of the matter is that the markets have stabilized, the markets are looking, and the government is looking at huge amount of FDI. A 1 year, a holding period has been regarded as long-term for listed equities. The question is, can a similar period be also provided for unlisted equity? How should we look at real estate? So maybe some degree of distinction between equity and real estate may be warranted. But really, even within equity, do you need to make distinction between listed and unlisted? And do you need to have multiple surcharges? Do you really need to have separate rates for resident and non-resident? Those are the asks. But as I'm saying, that be careful. I think the most important thing, just getting back to FICCI, and which you mentioned about, our ask was stability. Our ask was that we should not see changes year on year on year. We need to communicate to the world that India is a stable tax regime. So I would rather work more towards that than go on asking for concessions and anything else.
Okay. No, there was a big fear that actually the STCG could be increased on equity. That was what scared or will scare the market if it happens. Mr. Kapadia, any inputs on this?
No, see, the major change which we have seen, which has been introduced, is in the debt space to have a level playing field with banks, which was the ask for the banks, from the banks, as we know. For I think that part of the reform has already been attended to. Real estate keeps coming up, and it's counterintuitive that is really 2 years holding period long term. When you look at an asset like real estate, it used to be 3 years. To give impetus, you made it 2 years. It's neither here nor there. I don't think there's much scope for tinkering with the rate per se. Long-term capital gains tax for listed at 10% is one of the most attractive around the world. The market seems to be not having enough, there's more money than you want to have in the market already. So where is the need to give further incentive on that? If at all, is 10% really too low when the gains are too high? That could be the question. So I don't know what exactly is the expectation on capital gains tax. Simplification, yes. Certainty, yes, I agree. I think tinkering with rates just doesn't make too much sense at this stage.
Fair point. Actually, we saw this almost over 20% jump in income tax year on year, FY24. What we understand, and this is a Hindu Miscellaneous article, but we could all get that data. Much of that income tax, it's a doubling of capital gains tax in that income, which is one of the big reasons why income tax has gone up so much. So, why disturb something that's working so well? Seems a good argument. Mr. Kapadia, what would be the other big ask for you from the budget?
See, we have talked a lot about innovation and R&D, and income tax is not certainly a driver for this, but it is one of the very important incentives which governments have given. Countries have given around the world. We attempted something, it's a little known provision on patents way back in 2016. Our analysis suggests that it has not been really helpful in any way because of the restrictions. For example, I can only use patents for earning royalties, which is, I think, very, very myopic in that sense. So the suggestion here is you had a good incentive, it's not working. We should expand it. It should be extended to anything which I earn, even through patented products, for example. If you really want to kickstart innovation and be competitive in that sphere. So I think something more meaningful, either have something or, then you not have it if it is really not working. The second is you mentioned about the debate around disposable income, and the other is employment. Now there is a section again, which was introduced 8-10 years ago to encourage more recruitment by businesses, ATJJAA. But the threshold limit for salaries is very low. 25,000 rupees is really low. I think that should increase to really give that incentive to employers and help employment generation in the organized sector.
Okay. Well, incidentally, IT companies are accused that their minimum salary, at which they've been recruiting for the last 10 years is 3 lakh, your 25,000. So perhaps there is an incentive to raise that. Mr. Kanabar, again, now out of time, so we will, of course, invite you for more detailed conversation. But much of the FICCI requirements are simplification. Can you highlight what you all want most?
I think the one issue which keeps on coming up every year, and this year we seem to have a fair degree of acceptance, at least when we are communicating, is how do we resolve disputes sooner rather than later? Today we have, what has happened today is that we have litigation piled up at commissioner appeals levels. The tribunal probably is almost up to date. You could file an appeal before tribunal. But again, everything goes all the way to High Court and Supreme Court. And the question is there a way in which one can resolve disputes far faster? Is there a way in which one can put a settlement proposition where everything does not need to go all the way to litigation? So a number of asks here. One was that a dispute committee has been set up, but it has not yet been implemented. It's been out there for a year. Members have not been appointed. And that again is for small taxpayers. So the one ask was that can this committee be activated, number one, and number two, can we ensure that this committee takes up not just smaller disputes, but a higher level of disputes? And the other question was that can we get up the threshold for things that need to go to the court? A lot of work has happened in this, but can we really look at that not everything needs to go to the High Court and the Supreme Court? Once a tribunal has passed a judgment, can resolution come to an end? Because government is today the biggest litigation. So that, and again, is there a way to settle dispute outside of the framework? Can there be a committee to resolve disputes? So those are the sort of framework of what we are discussing.
Okay. Yes, gentlemen, out of time. This is just a teaser. Picture abhi baki hai. So closer to the budget, we will invite you again to check out what we may reasonably expect. This is the first year of a 5-year term. So some very important measures like dispute resolution or like simplification that Mr. Kapadia spoke about can be put in place, and you can see the benefits in your own term. So maybe we should expect those kinds of changes. Wrap up on Bazaar on that note. Chartbusters coming up.
Kotak Bank and City Union climb after brokerage firm Macquarie upgrades their stocks from neutral to outperform, citing cheap valuations and favorable risk reward.
Sun Pharma slips nearly 2% after the company's Dadra unit receives a warning letter from the US FDA that states violations to their current good manufacturing practice regulations.
PNB Housing Finance slides more than 4% after 5.5% equity changes hands in multiple block trade. Sources tell CNBC-TV18 is the Asia Opportunities and General Atlantic Singapore Fund who are likely sellers.
MAS Financial surges as sources say the company plans to raise up to 500 crore rupees via QIP. The stock is up close to 2.5%. Hello and welcome to Chartbusters. I'm Nigel D'Souza, and joining me as always is Mangalam Malu. Well, the headline index is as flat as can be. There's a fair bit of action though in the broader markets. You have a number of stocks advancing close to around 3:1. That's declining. Hey, Mangalam.
Hi, Nigel. Nothing really to worry for the markets because, yes, after a stellar run, we ran into a bit of resistance. And the good part is that, those dips are being bought into. So even as the frontline indices are consolidating, the broader market is doing well. And today, after a couple of days, we're seeing the market breadth look extremely strong with nearly 1,700 stocks in the green for about 600 in the red itself. So there you have it. Even as the frontline indices are off highs, we have the mid-cap index at the high point of trade and a fair distance between both the advances and the declines. But let's talk